Okay. Hi, everyone. Welcome to our podcast of Bryan's Business World. And today, our topic is going to be what makes a good deal. So you hear that phrase a lot. Everybody seems to say, I got a good deal. That wasn't a good deal. This was a good deal. So we're going to actually really dig in to what makes a good deal, and particularly in the context of business. Not whether you got a good deal on the car you just bought or the ribeye at the local market, but what is a good deal in terms of business to business. And this is especially important for business owners and entrepreneurs who may be looking to make significant deals to expand their business, or maybe they're in trouble. They need to sell off some of their assets or do some other things like that, or get some financing or exit their business. Did they get a good deal? What makes a good deal? So with that, my guest today is Ryan Miske, and he is a friend of mine from college from many eons ago. We're all getting older. I guess that's over 25 years in the rearview mirror now. So get me the Geritol and the achy joints and stuff. But so getting older, we're all unfortunately getting older. But Ryan's a college friend of mine who went on to law school and got an MBA as well. And he is a partner at, I think it's Faegre Drinker, but I will let Ryan talk to in a little bit of a by way of general introduction, and let him give a little bit more detail. He is a what's called an M&A attorney, so Mergers and Acquisitions attorney, and sort of his bread and butter is that he orchestrates deals for a lot of different types of companies, a lot of different types of individuals. So M&A, mergers and acquisitions, is the lingo. And he is very much involved with deal making, structuring deals, writing up the deals, but also working with all the different parties in the deals, with principals of the business, auditors, advisors, sometimes investment bankers, that type of thing. So without further ado, I'd like to welcome Ryan to the podcast. So welcome, Ryan.
Great. Thank you, Bryan. I'm happy to be here. Thank you for the invitation. So I'll start, I'll pick up where you left off. When we graduated from Carleton College, I worked for a company outside of Chicago, and I mention that just because I do have some real business experience. So for 3 years, I worked for a company called McMaster Car Supply Company. It still exists. It's privately held, and they had a management development program. And I moved through various facets of that company, ultimately becoming a manager in their shipping department before I decided it was time to go back to law school. I went to law school at the University of Minnesota in Minneapolis, Minnesota. And as Bryan mentioned, I did a joint degree, as he did, both a law degree and an MBA. And then I started at Faegre Drinker. At that point, it was Faegre and Benson. Our firm has gone through a couple of combinations, which has been common in the legal industry. So I've been there about 18 years, and I've been a partner for over 10 years now. And as Bryan said, I focus on mergers and acquisitions. I'm in our corporate group, and I have a subspecialty as well where I focus quite a bit on private equity transactions, representing private equity sponsors in their transactions. And I'm chair of our private equity practice. And, you know, in terms of deal size and industry.
So hold on, let me just back up a little bit here.
Yeah.
There's some folks listening that might not be as sort of nuanced in the legal market in law firms and stuff. Where does, and you said the firm you were with was Faegre Drinker, is that right? Did I hear that correctly? Mm-hmm. Okay. So where does Faegre Drinker stand sort of? Is it like a bigger firm, smaller firm? Can you give our listeners a little bit of insight about kind of what kind of firm, how big it is, where that's at sort of in the legal strata?
Yeah. When I started in 2006, we probably had about 475 lawyers, and we were what I would consider more of a regional, high quality, but regional firm. And then we've gone through two combinations where we've almost doubled in size each time. So we're about 1,100 lawyers now. We have more than 20 offices in the U.S. and also have offices in London, in Shanghai. And one of the rankings, is the AmLaw rankings in terms of revenue, and we rank among the top 50 law firms in the country in terms of revenue.
Okay, so Faegre Drinker is probably its top 50 or top 100 largest for sure firms in the country. Is that fair?
Yeah. Mm-hmm.
Okay.
Yeah, by revenue. Yep.
Okay.
And probably by size too.
Yeah.
But,
so you're certainly top 50, top 100, somewhere in that echelon. So
yeah.
So Faegre is a pretty big operation, big firm then, correct?
Mm-hmm. Yeah.
Okay. Now, you threw out another term in there, private equity. You said you were chair of the private equity group. Is that right?
That's correct. Yep.
Okay. And what, for our listeners who might not be as nuanced or familiar with what is private equity?
Yeah, there's probably more than one definition for private equity.
I asked you that question. I was deliberately setting you up for something very hard.
Yeah.
You can actually define private equity. So, but let's give it a go.
Yeah. I think when we use that term, often what we're referring to, are groups that pool capital to do primarily private deals. So, there's other kinds of deals around the edges, and sometimes you're taking a public company private as well. But I think loosely speaking, it's, buying or transacting with private companies versus public companies. And when I use the term, often what we're looking at are institutions or groups that raise capital, and they'll have a fund to go out and then do deals. And when I say deals, typically M&A deals. But they're raising capital from pensions, from high net worth individuals, and it's really become its own asset class over time now, and a fairly significant asset class, because if you turn back the clock 30 years ago, I suppose, it was like if you wanted to invest, it was often public companies. And now, the performance of private equity funds has, and it varies, but it has had a lot of success such that it's a good diversification for folks so that they have some exposure to private equity in addition to the public companies.
So and we won't go too far into this, but just to clarify for people. So the investors in private equity, whether it be like a pension fund or large corporation or even just some private wealthy investors, they typically would form a fund, and then this fund would go take the capital and invest in private deals, basically. Fair synopsis?
Yeah, it's fair. And I guess one thing to just point out, part of the reason for the pooling is so that they can maybe buy larger assets, but also so they have some diversification. So a fund oftentimes will have, 10, 15, or more assets in its portfolio, and that gives you some diversification within the portfolio so that your risk isn't concentrated in one particular company or industry.
Now, a lot of people have heard of venture. Now, this is a loaded question, I know, but I've got to ask it. But a lot of people have heard of venture capital funds, especially a lot of entrepreneurs and business owners. They may not be as familiar with the hedge funds or some of the private equity world, but they have heard of venture groups or even pooled angel groups. Are those types of fund a form of private equity?
I think as the term is typically used, it is different. And it really just comes down to stage and control of the investment. So I think the attributes that often distinguish venture capital from private equity is that venture capital tends to be less mature businesses. It might be even, pre-revenue. And also a lot of times the venture capital firms are taking a smaller slice. They're not necessarily looking for control of the company. Private equity tends to happen later in a company's life cycle. And then oftentimes, what's really important is EBITDA, earnings
Earnings
before
before
income.
interest, taxes, and depreciation and amortization for those of you not up to the latest accounting level. Sorry, go ahead, Ryan.
Yeah, no, that's right. And it's usually, it's not always the case, but it's typical that it'd be a change in control transaction, such that the private equity firm is taking a majority stake or controlling stake in the company.
Yeah. Okay. So can you tell us a little bit? So you said, all right, so you said you were chair of the private equity. Can you give us just kind of a descriptional background of kind of the types of deals that you have worked on?
Yeah, and although I'm chair of our private equity practice, I have also worked on deals where we're helping somebody launch their business and raise capital for the first time from friends or family or the first institutional capital, and then all the way up to representing Fortune 500 companies in their M&A strategy. So what I've done in terms of my level of my breadth of experience is quite broad, but I do have a lot of concentration in the private equity ecosystem.
Okay. So it sounds like you've done deals from very small stage, almost mom and pop businesses all the way up to Fortune 500. Is that correct?
Correct. Yep.
Okay. All right. So how many deals do you think you've actually worked on in your career at this point, just in rough approximate numbers?
Yeah, it's definitely several hundred, and it may be nearing 1,000.
Okay. All right. So you've seen a lot of deals. Excellent. Okay. So with that, let's segue in. So in Bryan's business world here, we typically like to define things so we can know what on earth we're talking about and what we're talking about for our listeners. So we've spoken of deals. Now you and I have always heard, well, that was a good deal. That was a bad deal. Everyone says that, regarding everything, really almost every subject under the sun, whether even it had anything to do with business or not. So-and-so got a good deal or a bad deal out of divorce court or whatever it might be, or this or that. So, or sentencing criminal. So now so let's talk about this. What is, a deal? Let's see if we can get our hand on this. So first of all, since we are talking with because we're going to have a lot of discussion on this, we don't know what a deal is, then that's going to be confusing. So would you agree that for the purposes of our sort of discussion, the deal is not, it isn't sort of a garden variety kind of personal transaction? So you can kind of agree with that we're not talking about that type of deal, right?
Mm-hmm. Correct.
Okay. All right. So we're talking about deals that are business to business for our series today. So we got business to business deals. So a deal is some sort of transaction between businesses. And would you agree with that?
Mm-hmm. Agreed.
Okay. But it can't be, but I think for our purposes, a deal is not what I call a routine transaction between businesses, which is like pending, routine sale to a customers, payments to vendors, that type of thing. So, you agree that we're not talking about that, right?
Agreed.
Okay. So the deal, so maybe I'll venture a definition of a deal here for our purposes, which would be there is a major agreement between two businesses which involves a significant amount of time and resources on both sides, and the intent of the business in entering into the deal is to further the important goals or strategic objectives of the respective businesses. Now, let me repeat that a little bit. That's kind of a bit of a long definition. So for us, the deal is a situation you have a major legal agreement between your businesses, which involves a significant commitment of time and resources on both sides of the deal. And the intent of both businesses in entering into this transaction is to further important goals or strategic objectives of their respective businesses. So do you think, Ryan, that is a robust enough definition? Would you add something to it? Thoughts?
No, I think that's a good definition. And just by way of example, I think if you think of a software company, that's in the business of selling software, on a daily or monthly basis, they're going to be selling software often via a license agreement. And that is a deal, right? At the end of the day, they are going to be selling, agreeing to provide software to a customer or client, and it might be over a year, 2 years, 3 year period before it might need to be renewed or amended. But I think for our purposes, we're not counting that, even though that is quote unquote a deal. But if that software company were to go out and buy a new technology or buy a new company to bolt on, that would be in our view fit our definition of a deal.
Yeah, yeah. And maybe what some other examples might be, like a fancy thing like a merger, which would be company A and company B create company C. So A plus B comes up with C in terms of that. Buying or selling the entire business would apply for a deal. Buying major assets or selling, like you said, buying major assets, like with the software example, buying a new technology, that's a deal. Potentially in long-term, very high dollar supplier sales contracts, that could be a major deal because that's a lot of revenue, significant commitment over time. Taking on major amounts of debt, that could be a deal. Raising capital by selling a lot of stock or equity, that could be a deal. A classic one is going public, initial public offering or IPO. A lot of people say that's a major deal. I would also add in that if you had a co-branded kind of joint venture thing, so two companies were going in on this new venture, and both their names were on it. It was a significant thing that could also be a deal. So there's a lot of different ways to have a deal in terms of under this definition. Now, we might have the easiest part behind us, which is defining what a deal is. So now we've got to say, okay, what makes a good deal? What is a good deal? How do you go about that? Everyone seems in common parlance to do that. Now, before I get into some of the details here, you've said you've seen in the neighborhood, I'm safely saying probably several hundred deals at minimum, Ryan, in your background. Well, let me back up actually a little bit. After you get done with these deals, do you have any further communication with one party or the other as to how the deals went, how they went down? The longer term, after it was closed.
Yeah, certainly. I mean, I have clients that I've worked with for decades now at this point, and so I do hear how deals went and how they performed, and I think I see it in particular. And it's one of the things I like about private equity is I often see the full life cycle of a deal for a private equity firm, because I'll help them make their initial investment, and then they'll try to grow organically. They'll try to grow through acquisition. And then ultimately, in private equity, I think the average hold period is 6 or 7 years. Obviously it depends on the fund. But now I've seen plenty where I've helped with the initial investment, and then I've seen the exit. And so in that case, I do see very clearly, and I hear from them how they measure the success. But you can take a look at, okay, what did we pay, for a company? What additional capital did we contribute along the way? And then what was our return? So in that case, it's fairly, visible, confidential in a lot of cases, but visible to me. Yeah.
Sure. Yeah. Because so for people who don't know, the lawyers on the deal often get to see everything, the numbers, whether you have any interest or not. You can actually, should you desire to. I mean, you can't reveal anything. The lawyer really sees everything, sees all the documents in the deal, all the financials, everything like that. So they have access. For those of you that don't know, listening, they have access to virtually anything, and you can almost do. If you're so inclined as a lawyer, some are not, you can almost do your own deal analytics. see if it went back of the envelope, and see this makes sense, or, was this a good deal, or not. even just from what Ryan was talking about there with, was there a good return? How much did they make? Things like that. So let me dive down in this a little bit here. What percentage would you say just there are some real rock, maybe not that it's a bad deal per se, but what percentage of those deals do you hear back that, wow, man, this isn't what we thought. These are some major headaches or major problems there. What percentage would that be for you in your experience?
Well, first you have to understand that I work with really smart and sophisticated clients. So I would say it's actually a fairly small percentage, but is there, I'm just going to say maybe 10%, and I don't think that's actually, if you look at the broader statistics, the sort of success rate that if you took all M&A, that companies experience or private equity funds experience. But from what I've seen, in a recent investment, I've seen where they did a string of add-ons over time. Mm-hmm. And even there was maybe one or two that didn't do so well, but others did so much better that they net out. And it was still overall like a very good investment for the private equity firm. But I think to answer your question more directly, in my experience, it's maybe 10, 15%, where okay. Things, you look back and you say, that didn't work out well. And sometimes it's not always because it was a bad investment. Sometimes it can be because there are changes in the industry, or there are other competitive dynamics that caused it to not go as well as planned.
Okay. So in layman's terms, maybe 10 to 15% you hear back, wow, that kind of sucked. Okay, that wasn't what we're thinking. And it might not actually be anybody's fault. I want to clarify that. It's not that the acquirer, the seller wasn't pulling a fast one. The acquirer, there'd be changes in industry. Things can happen. COVID can happen. I mean, if you had bought a restaurant chain, closed on it 2 months before COVID, you were not going to have an easy time of it. That was just how that goes. You know what I mean? If you were even lucky to survive it. So let's say you bought a group of 30 restaurants or something, a regional restaurant group you liked. That isn't anybody's fault. That's just how it goes. You know what I mean? That was going to be a very difficult time, at least for a while, on a deal like that. So it may not. All right. So 10 to 15%, like, wow, that didn't go. Now, in your view, what percentage would say like we're going to be arbitrary here, but let's venture arbitrary because I'm not sure there's an absolute standard, but let's go arbitrary. So a good return. Actually, let me back up. This is interesting. Okay, so deals where, if you have knowledge of, where they might have doubled their money, what percentage of all the deals you saw where that might have happened on the exit?
Yeah, and then I just have to ask over what period of time.
Okay, let's do that. Okay, let's take a.
So did they double it in a year, or did they double it in 10 years? So
let's take a long time to give it a chance to work. I think we should take a long horizon. So 10 years, doubling the money. If you're, from what you can see, and again, you may or may not have access to all of this stuff or this, you know what I mean? But what would you say situations where you're aware of, percentage-wise, would say doubling the money in a 10-year exit?
40% maybe, I would say.
Really?
Yeah.
40%? Okay.
Yeah, over a 10-year period. I mean, yeah.
All right. Now, I am, okay. All right. Now, that is in line with, I guess I shouldn't be terribly surprised. That's in line with what's called the Standard & Poor's S&P 500. So for those of you who don't know that, S&P 500 is a group of stocks. It's sort of a basket cross-industry of stocks, publicly traded stocks. And it's a very widely followed, it's considered a fairly accurate sort of cross-section of the economy, the S&P 500. Okay, so you might have heard the Dow. The Dow is very small, concentrated. People report the Dow a lot, but it's only the basically top 30 biggest companies. So it's not as big a cross-section. There's another one called the Russell 2000, which is a cross-section, 2,000 publicly traded companies. So S&P 500, and we may or may not dive into the show. We might. there are a lot of ways to calculate returns. But generally, the common benchmark for those of the uninitiated in the hard finance world is called internal rate of return, or IRR, okay, which looks at, as Ryan pointed out, the time it puts the return over time and then does some mathematics to give you kind of like what your annualized return was. Okay, so your annualized return. So there's something called the simple return, which is like you buy a company for, I'll just make it real simple, 10 million, you sell it for 20 million. Okay, you're now you can say, okay, that's doubling it, but was that over 20 or 30 years? Was that over 5 years? IRR, internal rate of return, allows you to just says, okay, because the return is higher if it's shorter time. Okay, so it's time bound, and that's why time bound is very important in looking at returns. That's why Ryan was asking you what's the horizon. Now, with all that, the S&P 500 matches kind of what Ryan's saying, which is roughly you can double your money in 10 years on average if you just invest in a cross market of stocks. And inflation adjusted, I'm going to be conservative here because I don't buy these people that say the S&P 500 does 10 to 12% a year on average, because they're not taking into account long-term averages where it can plummet and really reduce that down. So I'm going to say 7 to 10%. But if you're doing 7 to 10% annualized, yeah, that's roughly where you'll double it. So interesting. All right. So they're kind of, so it would be fair to conclude from this, Ryan, that, or at least preliminarily here, that it sounds like some of the longer term private equity exits are at least tracking the publicly traded markets. Fair enough.
Well, you'd hope so, right? Otherwise, why wouldn't folks just invest in the public markets?
Right.
Right. I mean, they're investing in private equity or any sort of alternative asset, hopefully to do better. Sometimes also to balance the risk, right? To just have some diversification as well.
Right.
But yeah.
Right. Now let's take a look at 5 years doubling the money. What percentage do you see of that, if any? Well, first of all, would you agree with me that is less, that it would be improving over a lot of the public markets if you hit that metric?
Yeah. Yeah.
Okay.
Then honestly, it's maybe like 30, 35%. It's still relatively high,
Okay.
So, I mean, in part because I mentioned, again, looking at private equity, they're often exiting in 6 to 7 years,
Yeah.
So, and when I have a client that, maybe is family owned and it doesn't trade, like, Warren Buffett likes to say is you don't get a valuation on your farm every day. You know what I mean? Or every year. And so that's a little less visible even to me, because I don't know if, perhaps they have doubled their value as a result of an acquisition. But I see it more in private equity because I see the whole life cycle from the beginning of investment to exit.
Interesting. Okay. Because they can buy to you to do the initial, to close the deal, do that or work with you. And then when they're exiting, they probably come back to you. Fair enough. And then that's how you can see what's happened, right?
In private equity?
Yes, in private equity.
Yeah. And oftentimes we're helping them along the way because they'll also try to grow through acquisition.
Okay. So, or they might be doing debt offerings or selling at, okay, they might be doing other deals or other things. So you're working with them kind of as they go. Okay. Interesting. Right. So you've got kind of, as they say, maybe not cradle to grave, but cradle to exit in terms of doing that. Okay. So you can see not just that, but you actually are involved with it and then to the exit. Okay. Interesting. But that also I think that makes your standpoint or your observations a bit more accurate, because you're seeing it from inception, everything from inception, seeing what they're doing all along, and then seeing what the exit looks like. And any problems, you're probably also aware of problems that may come up along the way. Interesting. Okay. So, doubling the money, 5 years, and that would be, doing that. Interesting. Okay. So I'm going to put you, this is very, very interesting, and I'm going to have to put you on the spot a little bit with this. So here we go. So in light of that, based on your upfront, so we've talked about what the public market returns look like, right? In light of what you've seen, would you put your own money in private equity funds if it were made available to you? Now, before you answer that, let me define for people. It's very hard to get into a lot of these private equity funds. There is sometimes a very high level of entry capital, like minimum investment size can be massive. There can be other requirements, what's called investor accreditation, or they won't take individuals at all in some funds. Like they don't care if you're Bill Gates. They won't take you. You know what I mean? They require an institution and other things. So what I'm saying here, Ryan, is I didn't know this, and for the audience members, Ryan and I haven't actually talked about this before. So this is news for me as I'm here listening here, but I've heard some interesting things. So it would seem like at least a section of private equity is beating, at least to some extent, the private markets. So would you, if available, would you invest in a private equity fund, Ryan?
Absolutely. But I'll mention two challenges. One is that, as I mentioned, the life cycle for an investment in a private equity fund is often 6 or 7 years. And so for them to fully deploy the money in the fund and then to exit all of their deals can be in excess of 10 years. So you're tying up that capital for 10 years, whereas let's say if you're in the S&P 500, you can get out on Monday, if you want to. Not probably advisable. So that is one challenge, is that you are tying up capital for a long period of time, or certainly longer than if in public markets. And then two, I would just say, in all fairness, not every private equity fund is created equal. I'm fortunate. Most of the funds I work with have done extremely well, performed extremely well. But like most things in life, there's a top quartile and there's a bottom quartile. And there's some private equity firms that haven't performed as well, and then they don't raise another fund because of that. So I think you also have to be thoughtful about which private equity funds you invest in.
Yeah, and this is I want to thank you for clarifying this, because the private equity world, it's private, it's opaque. They don't publish their returns, probably because maybe some of them don't want to. You know what I mean? Like they charge very high fees. They go out and they say, we've got this secret sauce. And it's very difficult to actually get benchmarks of performance on the private equity funds. They don't want to reveal it. You know what I mean? Now, you could say, well, we've got a great thing. We don't want everyone to know about it. That's one argument. Those of the more jaded set, such as myself, may say that a lot of people really aren't producing performance that should be there in light of the high fees they're charged. So for those of you that don't know the hedge or private equity fund, or even the fund world, especially the private fund world, there can be very high fees that the managers charge. You know what I mean? And they can be performance incentives and things like that. They can also be, as I said, very expensive to get into. So I find this is very helpful, I think, in pulling back the curtain a little bit from someone who's been in the front chair, seeing these things first on, that there are actually some funds that are producing results. Although a fair number, as you've indicated, 10 to 15% have some problems, and a good 30 to 40%, I think that's what you said, are kind of matching the public markets. So like you said, you've got, there's a group at least, probably not the overwhelming majority from what I've heard from what you said, that are beating the market though in private equity funds. So that's interesting. I think that's very, very helpful, and great information for people. I'd not heard that before today, actually. So now we kind of got a little bit off track there, but not much, because we are talking about deal returns and what makes a good deal. And these private equity funds are very much involved in deal making, as Ryan said. They're buying, selling companies, they're issuing equity, they're doing this and that. So it is relevant. Okay, so let's talk a little bit about reasons why people do deals, business people do deals. So I've got a list here. I'll run it by you, Ryan, and see what your thoughts are on this. And if you want to add anything or disagree, feel free, of course. So one is what I call customer acquisition or market share increase. So you do a deal to, build up your customers or market share. Maybe making that more concrete. That could be buying a smaller company to get its customer list. That's an easy way to expand into it. Very simple example might be you're a large landscaping company and you've got this small operation that has a ton of customers in this one neighborhood that you want to get into. You can just buy his customers basically by buying the business. kind of what you had said earlier, obtaining new technology or speeding the development of your own technology. So let's say someone's working on a particular software that you've been working on, but they're much further advanced. You could buy into that. Increasing efficiency and synergies. This is one of those gobbledygook MBA terms, synergies. I think a lot of companies don't actually combine that well, but we'll talk about that later. And that actually can be a real headache from an operations standpoint. But in theory, if you could meld operations and in theory get better efficiencies, quote unquote synergies. Defensive posture, business survival can be another reason to do the deal. You know what I mean? If there's a competitive threat to you, doing that. Building brand awareness, increasing revenues, increasing profitability, launching a new product or service, or cost cutting. So those are the list that I could come up with why people do, as we defined it, significant deals in business. Now we're going
Brian,
to.
I'll add one.
Yes, please do. Yes.
Sometimes I also see M&A for talent acquisition. So, and we call that, kind of an acqui-hire in some ways, but, and it's maybe more common in professional service, in the professional service industry, but sometimes, you're doing a deal in order to acquire, a certain bench of people, and you want them to join forces.
And what label, how did you label that again, Ryan? I missed it earlier.
I sometimes it's called an acqui-hire, cause it's like an acquisition, but for hiring purposes. So acqui-hire.
Interesting. Okay. I never heard that before. An acqui-hire.
Yeah.
Okay. I can go with that. That sounds, yeah. So kind of like, it's like you've got a deep bench of talent, in a given professional accounting, engineering firm, law firm, and you acquire to get that bench of talent.
Yeah.
Got it.
Engineers. Whatever, somebody might have a great team of engineers,
Yep.
And so you're buying it to get that whole team, cause you wouldn't otherwise be able to get them, to come over, for various reasons. They might have non-competes or whatnot, but, it's a way of kind of acquiring talent.
Yeah. It's also very hard to, deal. Yeah. And the other thing with this, it's also very hard to get the whole team.
Mm-hmm.
You know what I mean?
Exactly.
So if you've got 50 or 60 or let's say there's an engineering practice group or, whatever in a law firm, to get everybody to come all at once is really tricky, to get, because usually the magic happens because you've got the principals, you've got good support people, there's sort of a whole ecosystem there. Yeah, that would be very interesting. So it's called an acqui-hire then. Mm-hmm. All right. Well, I learned something here today. Excellent. Okay. So in the next episode, we're going to talk a little bit about, are these good reasons to do deals and how these things can go awry? And then we're going to come back, do these in fact make a good deal? Are these good reasons to do a deal? And what should you be looking at with this? AKA what makes a good deal? So, we are going to be back with our next episode. And in that episode, we are going to talk about, gaining customers. So it's a popular one. Acqui-hire. Oh, actually, acqui-hire is not that. It's gaining talent, just like gaining customers. You might indirectly, though Ryan does make a good point, you may indirectly on an acqui-hire get customers if these people have their own book of business. So if you're hiring an accounting or a law firm, medical practice, whatever, to get that, you may get that hires, that principal's book of business, which can be very substantial very valuable in certain industries. So we're going to do that. But we're going to look at more closely in the next episode here of gaining customers. Is this a good reason to do a deal? And B, what can go wrong and how it can go wrong, and therefore, where we come out with this. But a lot of that's very common with business people. I think you would agree with me, Ryan, that the number one thing is let's buy our customer list. Let's go out and acquire. Let's get the customer list. They've got a book of it. In all different types of industries. You hear that. You have to recreate the customers. They've got them. Does that work? And so we're going to explore that next episode. So thank you guys for listening, and we will be talking soon. Okay.